If you want to understand why markets can feel strongest right when ordinary life feels weakest, you have to stop assuming that Wall Street and Main Street are living in the same calendar. They are not. That is the whole story. The public keeps waiting for the market to behave like a moral scoreboard. Inflation is still irritating. Oil is rising. Consumers feel miserable. Rate cuts keep getting delayed. Housing is strained. The labor market no longer feels clean and easy. So the average person looks around and says something very reasonable. Why are stocks going up? The answer is not that the market is stupid. The answer is that the market is not pricing today. It is pricing the next version of today. That is the mother line. The market does not ask whether life, it asks who will own the future cash flows 12 months from now if the current pain eventually gets absorbed, inflated away, or politically managed into the next cycle. That is why this kind of environment can create something that feels almost offensive to ordinary people. A melt-up. Not because everything is healthy, because enough capital has decided that unhealthy conditions are temporary, while asset ownership still matters more than waiting for comfort. That is the split I want you to see. The reference document opens with the drama people always notice first. The Federal Reserve did not cut rates. Oil prices surged, inflation pressure returned, and instead of markets collapsing under that combination, stocks pushed higher, Bitcoin climbed, and asset prices started behaving like they could float above reality for a while longer. Most people hear that and think irrationality. I hear something more systematic. I hear a market recognizing that late cycle conditions do not always kill asset prices immediately. Sometimes they ignite the final phase where money starts running toward whatever seems most likely to preserve or expand nominal value before the real bill comes due. That is the first mechanism I want you to understand. I call it the tomorrow premium. The stock market is forward, looking in a way daily life is not. That sounds obvious until you live through an environment like this and feel how unnatural it is. The consumer is dealing with now. Grocery bills now, gas now, insurance now. The market is dealing with a very different question. If these costs stay high, who has pricing power? If the economy weakens, who still attracts capital? If rates stay higher for longer, what already got discounted enough to rip upward once the panic clears? If the cycle is ugly but survivable, which asset classes still look like the least worst home for money? That is a completely different conversation from what ordinary households are having. And this is why sentiment can look terrible while indexes surge. People think those two things should move together. They do not have to. Consumer sentiment is a measure of lived discomfort. Asset prices are a measure of discounted future ownership claims. When those two things split wide enough apart, people start feeling gaslit by the market. I understand why, but the split itself is not irrational. It is structural. The second mechanism is what I call the pain gap. Main Street experiences inflation as pain. Wall Street experiences inflation as a variable inside a portfolio decision. That distinction is brutal. When oil rises, households feel it immediately. Commuting costs rise, goods cost more, food costs more. The whole supply chain starts pressing on margins that were already thin. It feels like deterioration because it is deterioration at the level where life is actually lived. But capital does not only ask whether oil is painful. Capital asks what oil does to relative positioning, what sectors benefit, what companies can pass costs through, what assets become more attractive if the policy response later turns softer, what inflation hedges begin to wake up again. What does all of this do to real rates, nominal growth, and investor psychology? That is why the market can rise in environments that make ordinary people feel poorer. The market is not cheering their pain. It is reallocating around it. And once you understand that, a melt-up stops looking like pure madness and starts looking like a late cycle adaptation. This is where the source text gets especially useful. It notes something many people hate to admit. Stocks can rally hard even when the economy looks messy because the market is not waiting for the mess to vanish. It is waiting for the mess to become familiar enough that future upside again looks underpriced relative to the fear already felt. That is what happened here, a violent rally off pessimism. A fast move from oversold to overbought, a string of gains so sharp that anyone who sold for clarity, discovered clarity, arrives only after price already moved. That is an old lesson. The third mechanism is what I call the clarity trap. Most people do not lose in markets because they fail to identify fear. They lose because they demand emotional certainty before they re-enter risk. The market punishes that instinct over and over again. When things look the worst, the market often begins pricing survival. When things look the safest, the market often begins pricing disappointment. That is why I never built my life around the fantasy of timing the all clear. The all clear is one of the most expensive ideas in finance because by the time it arrives, much of the move is gone. This does not mean you buy recklessly. It means you respect one ugly truth. The best prices are often available when the narrative still feels disgusting. That is what the average person cannot tolerate. He wants the future to feel better before he pays for it. The market wants him to pay for it while he still feels sick. That is the entire game. Now let us talk about the Federal Reserve, because this is where people become much too simplistic. The public often treats the Fed as if it were a vending machine for asset prices. Rate cuts out, stocks up, rate hikes out, stocks down. Life would be much easier if that were true. It is not in the current environment. The absence of rate cuts matters. Yes, it raises the carrying cost of leverage. It keeps mortgage pressure elevated. It makes weak businesses weaker. It slows pieces of the economy that had already become dependent on cheap money. But the absence of cuts does not automatically destroy the market. If the market believes something else is still true, that future easing eventually returns, that nominal growth stays alive, that big companies remain resilient, that liquidity still finds somewhere to go. That policy, even if delayed, will ultimately bend before the system truly breaks. That is the deeper assumption inside this kind of rally. Not that the Fed is easy, that the Fed still cannot remain permanently hard if enough parts of the system start cracking. This is the fourth mechanism. I call it the policy shadow. Markets do not just price what the Fed does. They price what the Fed will probably be forced to do later if the consequences of current restraint grow too severe. That is why a no-cut environment can still coexist with rising stocks. Investors are not always buying today's rate setting. They are often buying tomorrow's policy surrender before it is publicly admitted. And the higher inflation stays, the uglier the path becomes, because then we enter a world the public understands emotionally but not financially. Everything feels expensive. The Fed cannot ease cleanly. Growth looks vulnerable, and yet assets still move higher. Why? Because in that environment, people begin choosing between different forms of damage. Cash loses purchasing power. Bonds can get hurt if inflation expectations stay unstable. Housing is constrained by mortgage costs, so money runs toward liquid equities, scarce assets, and whatever seems capable of outrunning the weakening unit. That is how a melt-up begins, not from comfort, from lack of better alternatives. The fifth mechanism is what I call nominal escape behavior. When people stop trusting the purchasing power of cash and stop trusting that policymakers will produce a clean landing, they do not necessarily retreat. Sometimes they stampede into assets, not because assets are cheap, because the currency itself feels less trustworthy as a long-duration place to hide. This is why Bitcoin's behavior in the source text matters. I am not making a religious argument for or against it. I am using it as a signal when stocks, crypto, and risk assets begin moving higher while ordinary sentiment remains awful. What you are often seeing is not optimism in the classical sense. You are seeing escape velocity behavior from money that no longer loves the alternatives. That is a much darker form of bullishness. But it is bullishness all the same. And this is where housing enters the conversation in a more subtle way. A lot of people expected higher rates to produce a straightforward housing collapse. That was always too simple. Housing is not only about rates. It is about locked in owners, inventory, regional affordability, migration, income quality, financing conditions, and the psychological refusal of sellers to meet buyers where the new rate regime says they should. That creates a strange market. Some regions soften, some stagnate. Some remain tight, national averages become less useful. And in the middle of all that, buyers still discover the same truth. Even if mortgage rates improve a bit over the next several years, a modest drop in financing costs does not magically turn an unaffordable market into an affordable one. It may help. It does not rescue. That matters because it means the housing market is no longer the simple relief valve people wanted. It cannot absorb the broader pressure cleanly, so capital keeps looking elsewhere for performance. That brings us back to stocks, and now we have to say the quiet part out loud. The sixth mechanism is what I call the rich feeling phase, late in a cycle, before the bill shows up in a way nobody can ignore. There is often a period where asset owners feel increasingly wealthy, even while the underlying economy is becoming more brittle. Stocks rise, speculative assets wake up, housing holds up better than expected in key areas. People who stayed invested feel brilliant. People who sold feel stupid. The whole environment begins to produce the intoxicating illusion that perhaps the system can simply levitate. This is the dangerous phase. Not because asset prices cannot continue rising, because they can. Dangerous because rising prices begin to erase memory. People forget how recently they were terrified. They forget why risks matter. They forget that the same system producing the melt-up is also producing the imbalances that make the eventual reckoning nastier. That is what I want you to respect. A melt-up is not proof of health. It is proof that liquidity, psychology, and nominal desperation can run faster than the structural cleanup. That is a very different thing. Now let us talk about what a serious investor should actually do with a framework like this. First, stop waiting for emotional comfort. Comfort is not a signal. It is usually a cost. Second, stop confusing macro ugliness with automatic bearishness for assets. An ugly macro backdrop can coexist with a powerful rally if enough money decides that ownership is still the least bad answer. Third, stay systematic. The source text makes this point in its own language. And I agree with the underlying principle. If you are trying to predict every Fed move, every oil move, every tariff move, every election twist, every tweet, every inflation print, you will eventually confuse yourself into inactivity or panic. That is not an investment strategy. That is a stress disorder with a chart subscription. A better framework is much more durable. Decide what you buy. Decide how much you buy. Buy through good conditions and bad size positions, so you can survive a real drawdown without becoming an emotional animal. And keep doing the work while others demand perfect visibility. That is how you survive the melt. Up if it continues, and the correction if it follows. The seventh mechanism is what I call disciplined participation. A lot of people think the lesson from violent rallies is that they must become more tactical, more nimble, more clever. Usually the opposite lesson is better. Violent rallies often remind you that the cost of being out of the market at the wrong time can be much worse than the discomfort of being in the market during ugly headlines. That does not mean mindless buying of anything. It means consistent exposure to things you are willing to own through discomfort. That is a very different posture. And if you want to be more tactical around the edges, fine. But build that on top of a system, not in place of one. Because the truth is very few people can consistently outguess a market being driven by policy shadows, inflation fear, oil spikes, sentiment collapses, and global capital rotation all at once. Most people who try will simply sell low, buy higher, and tell themselves the next entry will be better. That is fantasy. Now let me end where I began. The melt-up is not unbelievable because markets became irrational overnight. It is believable precisely because this is what late cycle systems often do. They produce discomfort for the average household and momentum for asset owners at the same time. They split lived reality from priced reality. They make ordinary people feel poorer while making portfolios look richer. They create one last stretch where everything feels more valuable before the underlying imbalances finally ask to be paid for. That does not tell you the exact day the cycle ends. It tells you the character of the phase you are in. And if you understand the character of the phase, you stop asking childish questions like, how can stocks go up if everything still feels bad? You start asking the adult question, if money no longer trusts comfort, where does it run? And how do I make sure I'm not standing outside that move, waiting for emotional permission that will only arrive after the price has already left me behind? That is the real question. And in a melt-up, answering it correctly matters a lot more than winning an argument about whether the headlines look optimistic enough.